Ladies and gentlemen, good day and welcome to TrustLine Holdings Investor Call for PMS Fund. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO, and Chief Investment Officer. Thank you, and over to you, Mr. Arunagiri.
Thank you. Good evening. Hi, everyone. Welcome to our investor call. Thanks for joining this call on a very busy weekday. As all of you know, we do this call every 6 months, and these calls give us a forum to connect with you all, and also to provide us an opportunity to share our perspective on the markets and discuss in detail about how the portfolio is shaping up. So in that sense, I always look forward to these calls, and this particular call is no exception. And in terms of structure of the call, it's the usual structure which we always follow. We begin with the opening commentary, which covers on the markets, current market setting, and then move on to portfolio highlights, and then conclude with Q&A. So that's the overall plan. So without taking too much time, let me straight get into the current market setting. So what I'm going to do here is to split this into two parts. One, look at the global backdrop, global markets backdrop, and discuss a little briefly about how we are set, and then spend a little more time on Indian market setting. So in terms of global markets, I think we noticed two distinct trends which stand out actually. First, a gradual weakening of the US dollar, and second, a slow but steady de-risking from US assets. These trends seem to be gathering momentum. Now, why do we say this? Now, all that one needs to look at to check whether these trends are actually playing out is to look at the divergence between US market returns and the emerging market, also the world markets ex-US. The divergence in performance between these two markets are very, very stark for the current year after a very, very long time. So if you look at MSCI World Total Returns Index ex-US, it has done close to about 20% plus, whereas S&P 500 in US has done about 6%. Same thing if you look at MSCI Emerging Market Index, it has done over 15% YTD, whereas US S&P has done only about 6%. So there is a very stark difference in terms of performance. This is happening after very, very long periods of time, many, many years. So one is seeing this, divergence that in a way reflecting the weakening dollar trend, also some kind of a shift or rotation from US assets to the rest of the world. And in terms of the trend in terms of de-risking from US assets, it's not very hard to find the reasons. All of us know about the US debt issue in absolute numbers. But what many of us may not realize is the kind of refinancing which is going to come in the next 1 year plus 4 years. If you look at the numbers, the next 1 year, we have about $9 trillion of debt which needs to get refinanced. And if you look at the same number for next 4 years, it's almost about $27 trillion, which is, almost 75% of the overall debt. All of these need to get refinanced at a very, very elevated rates. Current US yield is at almost close to about 4.5% 10-year yield. So that's a risk profile which many investors are worried about. That's one of the reasons, at this point in time, the US markets have taken it lightly. We really don't know when this will become an overhang for US markets. At what point in time US markets will start pricing in, no one knows. But I think the savvy investors have started worrying about the risk profile of the debt refinancing more than the absolute debt level. Because absolute debt level has been high for a while, for a long time. But the refinancing is, many of us probably may not have given too much attention, but the market is giving more and more attention to that particular dynamics. That's one of the reasons you find this diversification from U.S. assets probably might gain more traction in the coming months and years. This is as far as the global markets are concerned. Now coming to Indian markets, which is more relevant for this, the environment is very, very clear. I have extensively written about this, both in the recently appeared ET article as well as in our recent latest video post. Indian markets are going through a twin engine problem. Both the engines that are very critical for the markets do not have much steam left. If you look at the two engines which are critical for the market breakout, one is the valuation engine, the other one is the earnings upgrade engine. Now let's look at the valuation engine. On the valuation, market has done more than its due part long time back. If you look at the last 2 years, Indian markets have been trading at a multiple which are at a premium to historical averages, much higher premium to historical averages. So there is not much steam left in terms of valuation multiple re-rating. If at all something could happen, it could be only a downward adjustment. But given the robust macro in terms of, falling twin deficits, rising currency reserves, and moderating inflation and resilient rupee, your macro is so strong, the multiples probably may sustain at these elevated levels without any downward correction. But in terms of market breakout, you need one of these engines, either multiple re-rating, which is not there, there's not much of a steam left, or you need to have an earning cushion. Coming to the other engine, which is your corporate earnings upgrade, do we have a cushion there? Is there a case for a big earning upgrade? This is where I think the structural weakness in the economy creeps in. Unfortunately, the key economic drivers are all stuck in the low gear. Be it private consumption, private investment, or net exports, all of them are struggling to move out of the range. Like markets, they are also stuck in a range. Now with renewed tariff uncertainties and tariff war amid a downgrade in global growth, it's unlikely that we will witness any meaningful breakouts in any of these, except some, brief momentum in consumption because of this bonanza from RBI in terms of liquidity and repo rates. Beyond that, one is not noticing any trend of a breakout in these dynamics on the economy, which can effectively, come down to boosting your earnings. So this engine, even in this engine, you are not seeing much of the steam left. So as a result, we find ourselves in a very, very contrasting market setup. On one hand, the macro environment remains so robust and strong that it's unlikely that the market will correct, and it's likely to sustain this elevated multiple level for the markets because of the robust macro. On the other hand, the absence of any meaningful earnings upgrade amid all this stretched valuation limits the case for a very decisive breakout in the indices. So basically, we are in a situation where we need to settle for a kind of a sideways spell for the markets, for the indices, and with markets unlikely to break out of the current range in a sustained manner. That said, given the strength of both FIs and domestic flows, we can expect multiple breakout attempts, like what we had seen, not recently, but about a couple of weeks back, where end of June, there was a kind of optimism that the markets are likely to break out, right? These kind of false attempts, false starts, you will see a lot in the coming days and weeks, but unlikely to break out in a sustainable manner without a clear earnings catalyst, which is currently not visible. So basically, you are going to see a lot of false starts, kind of brief breakout, which will fizzle out as quickly as they begin. So it doesn't mean the sideways markets are bad, especially for bottom-up stock pickers like us, as the market trend will favor bottom fishing and value strategies compared to momentum strategy, which was a very rewarding strategy for the last 2 years. Unfortunately, a bottom-up stock picking strategy or a value strategy had to endure quite a terrible underperformance for last almost 1 to 1.5 years. The tide might be turning for such strategies compared to momentum strategy, which was ruling last 1.5 years. So looking at the aggregate index level may not tell you the full story. When you go down to broader universe, one can find many opportunities, even in this sideways kind of a market movement, that meet at least one engine criteria, if not the twin engine tailwinds. So there are many stock-specific opportunities where you might, find one of these engines kind of supportive, in which you can still identify such opportunities and unlock gains. That's why this consolidation phase or the time correction phase at the index level, or whichever way one may want to put the current market setting, may after all be a great time for stock pickers. Also, the stocks that have underperformed over the last 10 to 20 months because of earnings soft patch cyclically are the ones that might do well or that might do the heavy lifting for the portfolio performance in the coming year, as earning tailwinds come to support them. So, in summary, I think this is, Indian market setting. If you look at it, I think it is, it's kind of a time correction phase or a consolidation phase, which you will see at the index level. So it may be going here and there, but unlikely to break out in a meaningful manner. But underneath, a lot of stocks, you will find actions. And if you are in the right stock, you would still, the portfolio can still make a meaningful return this year. So with this, let me conclude the overall opening commentary, and thank you all. Look forward to see you again in my next investor call, which will be 6 months away. Thanks a lot. Thanks for participating. Thank you.
Thank you. On behalf of TrustLine Holdings, we conclude this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.